Hello, I'm MaryAnn. Welcome to the first webcast of the new year. I'm here today with Bob Gorman, who is Chief Portfolio Strategist at TD Wealth, and we're talking about where to invest in 2014. Now, I know you have a bunch of themes, Bob. Let's start off with the first one.
Okay, well, first let's look at the U.S. stock market. And for 2014, we think the U.S. market is going to go up for the 6th consecutive year. That's a very rare event,
nice.
But we think it is highly probable, driven by continued strength in housing, the auto sector, continued revitalization of American manufacturing, and strength in the energy sector. Now, the market won't do as well as it has in the past year, in large part because performance in 2013 was largely a function of an expanding PE multiple, which went from 14 to 16 over the past year. In the coming year, we don't think that is likely, and instead, the market will go up in line with earnings growth, which is probably about 5% or so. Add a few percent in dividends, you've got total returns on the order of about 7%. Now, the second point with respect to the U.S. market is a likely rotational leadership from the small company shares to the large, something we last saw in 2011. Right now, you've got a big gap in valuation between the more expensive small caps, which have multiples in the high 20s, and the S&P 500, 16 and change. That's not likely sustainable. So expect a rotation from the small to the large in 2014. So those are the two key things to look for within the U.S. market in the coming year.
Any particular sectors you like?
There are several. First of all, in the financial sector, we have liked and continue to like some of the big banks in the U.S. They're going to benefit from accelerating economic growth and at the same time, a modest increase in long-term interest rates, which means a steeper yield curve, widening net interest margins. So my favorite stock there in recent years has been JP Morgan, and I would stick with that. It was up 36% last year. I think it has another good year ahead of it. And Wells Fargo, which had a similar return last year.
So even though JP's had been in the news quite a bit, you're still liking it?
The issues that they've had have been significant, but really don't detract from their earnings power going forward. So their earnings should continue to rise. The stock is still relatively inexpensive, so watch for it to have another good year in 2014.
All right, sounds good. And what's your next theme?
The next one brings us to Canada. And for the past 3 years, the Canadian market has sharply underperformed the American, which was pretty much as we'd anticipated. Going forward, we think that period of widely divergent returns is coming to an end, and you're going to see a convergence of returns between the Canadian and U.S. markets in 2013. So watch for Canadian returns to be very similar to the American in the coming year, so total returns on the order of about 7% or so, like the American. The second point with respect to Canada is that over the past 3 years, we've really focused our attention on the dividend growth stocks, the big, boring businesses that have consistent growth in sales, earnings, and dividends. They've really been where the action has been. For the most part, that is going to continue in the coming year, although the resource sectors, which have been very hard hit in recent years, should do somewhat better as you have the first year of synchronous global growth, which should provide some modest support for the commodity markets. So dividend growth within the context of a pretty decent Canadian market for the coming year is where you want to be.
So what would you say for a Canadian investor then? Should they be invested in Canada or the U.S., both?
Well, generally speaking, for most taxable Canadian investors, Canada is the biggest portion of their portfolio. Our biggest overweight overall has been in the States, and that continues to be the case. So overall, between the States and international holdings, we have more than Canada, but Canada is the single biggest component on a standalone basis.
Now, is there currency risk right now with the dollar moving so much?
Over the past year or so, we've been of the view that the Canadian dollar would slip from what had been par to 103 down to the low 90s, which is pretty much in line with most economists' view of fair value. We're rapidly approaching that. Given the continued soft trade numbers that Canada's exhibited, we may go a little lower than that. I think we've seen most of the decline in the Canadian currency from here, but you may have a little follow through from this point forward.
All right, so where do you like in Canada?
Well, continuing on the dividend growth theme, among the financials, I'd say the Bank of Nova Scotia, which has done well but lagged some of its peers because of its international exposure, will probably benefit from that international exposure in 2014. It would be helpful in the coming year to have a little more life insurance exposure. Those companies are beneficiaries of rising bond yields. So Power Corporation is a nice indirect play on life insurance with its ownership of Great-West Life and has the benefit of its exposure to Investors Group, which it also owns, which is an indirect play on the Canadian stock market. In the communications area, a bit of a contrarian pick for the coming year would be Rogers Communications. It's lost a little market share to some of its competitors, is selling at a discount. I think they will benefit from the input of their new CEO who comes from Vodafone in the UK. Watch for a greater focus on customer service and some cost cutting there, and a dividend increase I think is imminent. So that should be helpful there. On the resource sector side of things, I'll stick with my favorite names, Suncor, which is going to continue to benefit from rising production and free cash flow and has outperformed its peers by a wide margin in recent years, and Teck, which was our only loser over the past year in our top selections, but I think going forward we'll start to benefit from a little firmness in both the base metals and metallurgical coal markets.
And do you see oil going higher?
I don't think oil is really going to move very much. On the one hand, you have increasing production, both in the States and more production released from Iran. At the same time, that'll be largely offset by this synchronous global growth that I referred to. So I don't see oil likely moving a lot in either direction. I think it's going to be within a fairly narrow trading range, probably centered around $95 or so in 2014.
All right, let's try your last theme.
Well, let's go then to the international markets. And the big story here is that Europe, which has been seeing a shrinking economy since the credit crisis, started to see the halting of that contraction in mid-2013. And in 2014, we'll see the first year of growth in a while. It'll be modest, about 1%, but not too bad. We have focused our attention in the European market on the large caps based in Northern Europe with global exposure. They've done quite well, and I think that'll continue to be the case. A new name that I like is Roche Holdings, which is a big Swiss pharmaceutical firm with about 24 high caliber drugs in the pipeline and a good dividend while you wait. Another repeat selection of mine is Nestle, which I've liked for many years, has done continuously quite nicely, and I think will continue to advance in the coming year. You paid a nice dividend while you wait. It's a company with great indirect emerging market exposure.
Now, do you find that the healthcare, are they companies, are they getting benefits from this Obamacare that's going on in the States?
I think when you put all the rhetoric aside, it's helpful to remember that at the moment, about 83% of Americans have healthcare coverage. 3 or 4 years out, when this program is likely fully implemented, that percentage will be in the low 90s, which means that another 25 to 30 million Americans will be in a position to get pharmaceutical products or have health insurance coverage. And so I think by and large, it's no coincidence that the pharma stocks have done quite well. And I think going forward, some of the insurers, which have been under a bit of a cloud, will likely do well going forward. United Health Group, a member of the Dow 30, is trading at a sharp discount to the market. And I think it should continue its recent move upward in 2014.
Thanks, Bob. Always fascinating. I've been joined by Bob Gorman, who is Chief Portfolio Strategist at TD Wealth. Thanks for watching. Join us again next time. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.